How do you know when your trading system isn't working, and do you know what to do about it? This is Bill Scheid from Applied Finance Research, and in this video I share what I consider to be one of the most important and most overlooked edges in trading, and that is having a set of rules for knowing when to stop trading a system and what to do about a system that's not working. The concept that we're going to talk about here was inspired by one of my mentors, Dr. Van Tharp, who said, never get into a position without knowing where you'll get out. I've expanded upon that in my own work, and the belief that I have is never start trading a system without knowing when you'll stop. So how do we operationalize that belief? Well, as you know, in all of the systems that I trade, that I teach, that I build, I add a 9th system component to the 8 system components as classically taught by Dr. Van Tharp. So all of my systems have these first 8. As you know, they're market filter, setup conditions, entry signal, worst case stop loss, re-entry, profit taking, a position sizing algorithm, and having multiple systems for different market conditions. The 9th component that I add to all of the systems I build, trade, and teach is having rules for how we will know the system is not working and what actions we will take. So let's dive into both of these elements, how we will know the system's not working and what actions we'll take. And for each of these elements, let's take a look at the rules themselves, tactically speaking, and the value of the rules, the edges that these rules create. So first of all, let's look at how will we know the system is not working. So there are 2 tactical parts to the rule, and without getting too much into the weeds for any specific given system, the first part of the rule has to do with exceeding the expected maximum drawdown, and the second part of the rule has to do with variance from the statistically expected system performance as projected by Monte Carlo simulations. So when we see both of those elements in play, that's how we define that our system is not working. Now let's talk about the value of having a rule in this domain, the edge of the rule in this domain. And it is actually a huge edge. I think it's very often overlooked or ignored by traders. Part of the edge is that you're never wondering if the system is working and if you should be following the rules or not. You have a rule for that. You can quantify and measure when the system isn't working. And then you also have rules for what to do about that, what actions to take when the system isn't working. And in fact, we're going to look at that in the very next slide. So all of this allows you to act logically and rationally. So it removes emotion and blind faith. It removes cognitive bias. It reduces emotional stress and cognitive load. And basically what it does is it replaces hold on and hope with analyze and respond. So now let's take a look at what will we do when the system is not working. Let's take a look at the tactical part of the rules for this. Again, without getting too much into the weeds on the details for a specific system, the first part of the rules has to do with making modifications to the position sizing algorithm or the phase of trading. When I say phase of trading, in my system research and development protocol, there are 4 phases. There's backtest, paper trade, prototype, and production. So for example, let's say we were at production level of trading, and according to our analysis, we define that our system is not working. So perhaps we back up a phase and we go to prototype trading, which is live trading, real time, real money, but very, very small risk. Or maybe we even step back one more phase and we go to paper trading, which is real time but not real money. The next part of the rules has to do with renewed system analysis based on the most recent performance. So we're going to add the most recent trades to the prior data set, and reevaluate the system. We could ask ourselves, would we trade it now given what the new numbers look like? Or is the new level of risk acceptable? Is the new level of performance sufficient to meet our objectives? Now, what is the value of having rules in this domain? What edge does this provide us? Well, the first thing is it preserves capital. It allows us to stop the bleeding, and we live to trade another day. As we know from the teachings of Dr. Van Tharp, one of the biggest objectives in trading is to survive the worst case in the short term so we can achieve a positive expectancy in the long term. So this helps us avoid that worst case in the short term and live to trade another day. This also helps us investigate obvious causes of recent underperformance, which requires that we understand what constitutes unfavorable market conditions for our systems. And having that understanding is in fact an edge itself. Also, these rules give us statistical insight into the impact of recent performance on potential future performance. So because step 2 has to do with renewed system analysis, we're getting some insight into what potential future performance could look like. And finally, all of this provides a structure for ongoing monitoring of system performance and a decision-making framework for potential future adjustments to position sizing or the phase of trading. In other words, we're going to continue to monitor and evaluate the performance of the system. If we see that the system comes back into phase with the market and it begins to work again, now we have a way to make some rational decisions about how we might re-engage with the system. This is Bill Scheid from Applied Finance Research. Thank you very much for watching, and happy investing.